Good morning. I'm Gord Long with the Financial Repression Authority. As part of our series on the Austrian School of Economics, I have John Charalambakis, Managing Director of Black Summit Financial Group, joining us this morning. Welcome, John.
Hi, Gord. How are you?
Well, it's nice to have you. I've been looking forward to getting you on for a while. We've had some false starts, but today's looks like it's going to be a good one here. John, a lot of our listeners may not know your background, may not be familiar with Black Summit. Could you give an overview of the things you've been involved with and what Black Summit does?
Sure. I was born and raised in Athens, Greece, the epicenter of financial instability in Europe. I came to the US in 1987, and Black Summit, I'm the managing director of Black Summit Financial Group, which is a boutique-style asset and wealth management firm focusing on risk mitigation, capital preservation, and growth through strategies that are rules-based.
And we're going to have a chance to show some of the discipline that you put in to your work as we a little later on in the interview, and I'm looking forward to that part of it. One of the things, part of the series is on financial repression, and I wonder, John, if you could define what you believe financial repression to be in your words, and I know you brought a few charts that really help describe it too, before we move into Austrian economics.
Sure. If we could identify the forces of financial repression and then the outcome of financial repression, we could say that financial repression is when the role of the markets is diminished because of the actions of central authorities, such as the central banks. So one of the charts that we can see is to look at the balance sheet of central banks since 2007. So if we look at this slide, we will see that for the Central Bank of the United States, the Fed, the European Central Bank, the ECB, and certainly the Bank of Japan, the assets under management skyrocketed from less than 10%, about 7% for the US Fed, to over 20% as of the end of 2015. So they increased 3 times. More certainly, the GDP did not increase 3 times. So eventually, we see a greater role of central authorities. Now, if we look at the case of Japan, in 2007, they had about 20% of their GDP in their balance sheet, and right now they have over 90%. So the role of the markets is diminishing, and the role of central authorities is increasing. That's financial repression. What could be the consequences of that? Or we can look at another slide and see what the person who had saved, let's say $100,000 and put in a certificate of deposit in the late 80s or in the 90s. On average, that person would have received on an annual basis $8,000 to $10,000 a year. $8,000 to $10,000 is some income. Right now, that same person, the same $100,000, generates $370. That's financial repression. So it's bad for those people who have a tendency to save. It's bad for retirees. It's bad for pension plans. So what we are observing right now is that in the near future, we're going to see a mismatch between assets and liabilities in pension funds. And we have seen this game played before between assets and liabilities. Let's not forget the savings and loan crisis in the late 80s in the United States. It was the result of a mismatch between assets and liabilities. So when that happens, especially will happen on a global scale, we could have an eruption, a shock, and then a shock is followed by a crisis.
The pensioners are being just devastated right now, and your example is a great one, who had saved, let's say, $300,000, and normal 6% was going to be equivalent to what they were going to get for Social Security and the 3 legs of the, so it was another, except that leg's been pulled out right from under them right now, and it could get worse. So the question is, you said assets and liability, what assets should they be in this era of financial repression that would be a store of value that may not give them the yield but would protect their money?
Yeah, I think that the goal of any pension fund, of any institutional investor or individual investor should be capital preservation. That's goal number one. And assets should have intrinsic value. We're talking about hard assets versus paper assets. A bond could be considered an asset, even if when we buy a bond, eventually we buy a third-party liability, right? Because if that party doesn't perform, then the asset disappears overnight. So assets that have intrinsic value, such as gold or silver, historically, through thousands of years, have retained their value, especially in times of crisis. Let's not forget what happened to the gold price in 2009, 2010. Gold in 2009 was about 500, 550, and eventually went up to 1900. Why? Because investors rushed for the exit, for a safe haven. When the next crisis comes, and we know it will come, we don't know when it will come, then fund managers, investors will hit the exits. But there is not enough gold for everybody. Unfortunately, only 1/3 of 1%, that's minuscule, that's insignificant, is invested in precious metals. So let's say that every manager by the end of 2016 decides to put 3%, just 3% in precious metals. It's not enough out there. If 3% for every portfolio is put into precious metals, the price of gold we have estimated to be today about 2,700. So that will happen. We don't know when it will happen, but it will happen because of financial instability. And over the weekend, I was studying financial stress. Financial stress, even if you look, we don't have this slide, but financial stress, if you look at the St. Louis Fed index of financial stress, you will see that has been sustained and it's growing and it's being built up. It's ready to cross the threshold level. The moment it crosses the threshold level and is sustained there, then like in 1997, 98, 2007, 2008, an amalgam of shocks will be created that will lead to a crisis. Again, we don't know when it will be, but it will happen. So financial stress are being built up.
It's interesting. You mentioned the financial stress with the reserve. We look at it too, and we're very concerned about the same thing that you're looking at. But in an era of financial repression, you're stressing capital preservation. The most important thing is preserving the capital, and then looking at investments that are really ones that are clear stores of value. Am I summarizing that correctly?
Absolutely.
So if that's the case, then John, from an Austrian School of Economics standpoint, which actually talks about this, I'll use it, hard currency, money value, sound money, if I can use that expression. What are the key tenets in the Austrian School of Economics that really would help guide you today with that discussion of financial repression behind us?
If we can pull a top 10 points for the Austrian School of Thought, I would say the following. Number one, uncertainty is endogenous into the markets. Mm-hmm. And therefore, if uncertainty is endogenous, investments should be based on rules. Rules should rule. So regardless of policy shifts and regardless of where the market temporarily may be moving, the investor, whether it's individual or institutional, should be guided by rules. That's, I would say, principle number one. Principle number two is that investors, fortunately or unfortunately, are emotional beings. And therefore, there are psychological deficiencies by being moved through emotions. And therefore, the policy implication, the investment implication of that is that most of the times it's a moving target and it's an elusive moving target. If we have to achieve any targets at all, let's say I want a 7% growth in my capital every year, we have to follow a disciplined approach. Therefore, following for point number one, because we are emotional beings and we suffer from psychological deficiencies, we have to be disciplined investors following the rules. Point number 3, the conventional methodology eventually says 60-40, 60% in stocks, 40% in bonds. And that conventional methodology ignores two basic facts. Fact number 1, it ignores the risk parity considerations. Let me give you an example. The 60-40 approach would not have worked, actually worked very badly in 2008, 2009, 2010. Why? Because bonds at that point were considered safe haven. Let's not forget, in 2009, 2010, 2011, bonds, treasuries, returned over 30%. Why? Because money left stocks and went to bonds. Therefore, risk parity tells you, depending upon the macro environment of risk, you shift your portfolio in order to take advantage of the safe haven, what is considered safe haven at that point. So the conventional approach of 60-40 is wrong.
The conventional approach of 60-40 ignores two basic things in risk analysis. The first thing that it ignores is risk parity. By risk parity, we mean that we have to look at the macro risk and then rebalance the portfolio based upon what we foresee as the greater risk out there. For example, the 60-40 approach would not have worked in 2008, 2009, 2010. Why? Because more returns were forthcoming from the bond market than from the stock market. Actually, the stock market lost 1/3 of its value in 2008 and 2009. Therefore, at that point, investors were looking for a safe haven. The safe haven was either gold or the treasuries. Let's not forget that the treasuries in 2009, 2010 returned over 30%. So at that point, the risk parity eventually tells you, mitigate your portfolio, migrate your portfolio more towards bonds than stocks. That is what the traditional conventional wisdom ignores, the risk parity consideration. The other thing that it ignores is a potential black swan phenomenon. An unfortunate event like 9/11 changes the country and the markets forever. Therefore, because black swan phenomena will come again, and they will come more probably in greater frequency than we have seen them before, we need to be prepared and eventually hedge our portfolios in such a way that we can minimize the risk, in other words, sacrifice some return for the sake of stability and preservation. And that is the third principle of the Austrian school of thought regarding investments and the macro environment in general. So we started with the rules-based, we need to be disciplined, then we need to mitigate and hedge the portfolio in such a way that eventually brings stability and greater prospects into the portfolio. That's the third principle. The fourth principle follows from the third and eventually says that portfolios need to be structured in such a way as to survive all points in a cycle, in a macro cycle and a business cycle. And unfortunately, portfolios nowadays are not structured in such a way to survive, let's say, the credit cycle. Right now, the credit cycle is such that we may see in 2016 going from the high yield bonds, the risk, to migrate to corporates. And when it hits corporates, it will soon hit the equities. And when it hits the equities, it will hit eventually all the portfolios. So portfolios, unfortunately, are structured not being able to survive the credit, the macro, and the business cycle. That's principle number 4. So the diversification from principle number 4 that comes out eventually says you need to be diversified across across asset classes, and at the same time have some asset classes that other people eventually would ignore, such as precious metals. That's just an example. Principle number 4. The markets cannot escape, even if they want, the realities of wealth creation. what are the realities of wealth creation? We believe that we become wealthy by printing money. No nation became wealthy by printing money. Zimbabwe, if that were the case, would have been the wealthiest nation 5 years ago because it printed a lot of money. Haiti could be the wealthiest nations if they end up printing a lot of money. So wealth creation happens through free markets, and wealth creation happens when the entrepreneur is allowed to take the risk, because risk liberates. But when the entrepreneur eventually is suffocated by too much regulation, like it happens in the United States, or it happens in Europe or other parts of the globe, then eventually wealth cannot be created. Now, the markets always will find a way to create wealth. Therefore, investment principle number 5 is that, yes, part of the portfolio could be invested in some private equity, that if the due diligence analysis says it's a very promising idea, always with some risk, a lot of returns could be generated by investing in innovators and entrepreneurs who can really create wealth. That's principle number 5. I don't know, since we have crossed the first 5, if there are any questions, comments, or objections.
John, your summary of this is right on, with in agreement with some of the other guests we've had on, some of which Amin Rajan recently that surveyed 182 of the best pension insurance companies in Europe, and what the smartest minds in there were concluding and having to shift. And the whole element of true risk mitigation is central. And everybody kind of knows that, but understanding all the elements of risk, the disciplined approach, and how to do it. And part of their problem is there's so much correlation in the market today. It's hard to be hedged because everything's correlated. And you have to be hedged, you have to be on the opposite side of something to reduce your risk. So even that's difficult. It's changing alpha strategies. It's changing. They're having to move to know when to be risk on, risk off. That is in the market. It isn't about a 60-40 split anymore at all. Those days are long be gone, so it's very nimble. But it begs a question on risk mitigation. I know you practice you need a disciplined approach. You've got a couple charts that show the level of discipline that you believe people need to be at right now. But where I'd like to go on this is, everybody's using derivatives to protect on risk, or they think it in some kind of manner. We have a $500 trillion swaps market out there. What are the risks that you're worried about, and how do you protect against them in the context of this derivative monster that's out there?
Yeah, I remember that in February 2007, I read a report by the BIS, the Bank of International Settlements, in Basel, Switzerland. And that report was about derivatives. When I read it, I got scared, because eventually portrayed a market that had $720 trillion in derivatives. I know that's the notional amount, but when things erupt and a crisis comes, the notional amount becomes the full liability. In other words, let's assume that we have an insurance company, and the insurance company has insured all the homes in a particular area that is hit by an earthquake. On paper, the company could be bankrupt, because if all the homes are destroyed, their liabilities exceed their assets. They have to pay those liabilities. That's the notional amount. Now, we believe that it will never happen, but earthquakes do happen. And if there is a strong earthquake, let's say 10 on a Richter scale, potentially can devastate all the buildings in a particular area. If there is one company that has insured those buildings, then that company, by definition, by default, is bankrupt. So right now, the notional amount exceeds again 700 trillion. And if we take some additional derivatives out there, is 1.4 quadrillion. So let's forget the 1.4 quadrillion, and let's concentrate on the 700 trillion.
Which is the over-the-counter, non-exchange trade.
Absolutely.
In other words, privately traded between hands with no visibility and is totally opaque.
That's exactly right.
Or
that's exactly. And we have actually a graph showing that amount, and I have, hopefully you have received that graph that you.
I have it up here as we're talking. But John, can I just interrupt for 1 second? Because you were using a great example with housing and a storm or an earthquake. But they're all this 700 trillion in the swaps marketplace, so over the counter, is primarily interest rates or interest based and currency based, which means it depends. Which means the underlying collateral are bonds because they're risk free sovereign bonds and currencies. So any kind of currency dilemma or sovereign default underpins the whole collateral base.
That's correct. We have an inverted.
So that's called risk, but we call it. But we do that because we say sovereign bonds are risk free. Maybe they were at one day, but they're not anymore.
No. And I think that in 2016, most probably 2017, we're going to see some sovereign defaults.
Yes, exactly where I was going. Yeah. That's my concern.
Venezuela could be a sovereign default. Russia could be again a sovereign default. Azerbaijan.
Any of the oil countries right now, their current accounts are plummeting, and with their pegs could fail, which is currency, and we could see those, and etc. I'm not trying to preach doom and gloom. I'm preaching that risk mitigation today is critical.
Absolutely. It's extremely important to mitigate the risk, to analyze the risk, because the risk can be coming from different sources, and most of the times we ignore the majority of those forces. So currently we are hedging our portfolios. We start slowly buying again precious metals. We have in every portfolio a hedge. So in cases that markets start going sideways and south, we can eventually minimize the losses. And several times when the markets drop, you can still make money, right? The unfortunate thing is that we have an inverted pyramid, an inverted global pyramid, and I think I have sent you a slide about it, where in the inverted pyramid, we have the derivatives at the bottom of the pyramid, of the inverted pyramid. Then we have too much debt on the upper left corner, and too much instability because of capital flows. Everybody now has started talking about the capital flows out of China. China lost close to $700 billion in the last quarter of 2015. Why? Because of the liberalization of capital controls in China. People don't trust the Chinese authorities, which is a repressive authority, and therefore they want their money out. If you and I were there, we want the same thing. So if in one quarter, almost 20% of your portfolio is lost, imagine when everybody rushes for the exit. So does it mean that China is going to have a hard fall and a hard landing? Not necessarily, but it could happen. So we have financial instability because of capital flows. We have financial instability because of derivatives. We have financial instability because of too much debt. And therefore, we have rising spreads, as the graph shows. We have significant liquidity issues in the markets, including corporate bonds, US Treasuries, and most importantly, bond funds. I think that bond funds have significant liquidity issues, and also ETFs will have significant liquidity issues if we hit the crisis level. So are these stable? I would say no. In my opinion, they are not that stable, especially if financial stress keeps building up. And I think
you make a really major point we completely agree with you on, is the exposure in ETFs, and the equity side of it, and even in the bond ETFs, because of you can, at a keystroke, you can be out of your ETFs, at least you think you can be. But the seller who's got this portfolio has got to transact that. And for example, if they're bond ETFs, he can't sell them because there's no market makers. So what's going to happen is that we all go to our computers and start to sell, like in 2008 when we broke the buck and the CFOs started moving their dollars around to treasuries, and it happened within a few hours, everybody was doing it, with suddenly $5 trillion. And the point here is the markets will shut and you will not get out.
And therefore,
assuming I don't want to exaggerate.
Therefore, you have to wait.
So it's a different risk. The risk is, oh, I'll be quicker than anybody else. But the point is, the market will not be transacting because they know there's no liquidity.
And last time, if you waited 2 or 3 years, eventually you got some redemption, maybe 90 cents on a dollar. Next time around, because of what I call policy impotence, physical and monetary, the same game may not be played again. And I don't know if central banks still have many cards.
They have a few, but they're getting riskier and riskier. And I'm thinking of Japan going to negative interest rates, et cetera. And there's a overt monetary fall. There may be more games to go, but their credibility is falling quickly, which is a risk in itself, is it not?
That's exactly right. So unfortunately, risks are being built up, stresses are being built up, and portfolios are suffering the consequences. People think because they have wealth on their financial statement, that wealth can be preserved. Unfortunately, when the markets collide, that wealth is destroyed because it's paper wealth. It's not real wealth.
That's a really important point. It's not real wealth, it's paper wealth. A paper wealth is only a claim on real wealth. Right. And claims are exactly that. You've got a piece of paper with a claim, but you've got to settle it, as opposed to having real wealth. Now, in terms of knowing all of this, what should investors be doing? And I know one of the things that you think is going to evolve, and there's going to be a move towards infrastructure investment. Am I reading that correctly?
Yes, however, we're extremely cautious on that because infrastructure investment needs to be financed. And usually countries want to finance them through deficit spending. And deficit spending most probably cannot happen because they have already big holes in their budgets. Will private investors be allowed? Even if they are allowed, I don't know if the returns, the IRR, the internal rate of return, justifies major infrastructure. It's an area that we look at, but we are not investing currently. We're just examining it as a potential asset class because the environment, I don't think, is mature yet for that to happen. We have the possibility of a crisis erupting in the next couple of years, and that will put behind the infrastructure spending. If a crisis is avoided and things turn normal by the beginning of 2017, yes, most certainly that will be an area we will be looking at.
So I get a sense that you think there's definitely some kind of crisis coming at some point that's going to be significant. What should people be doing to prepare for that right now? If it's going to come, when you can't time it, but knowing that it's there.
I would look at the graph that I sent you, the schematic I sent you about the risk analysis. And I would say, analyze your risk first and foremost. Understand where the risk is coming from. Then anchor the portfolio as the bottom left part of the schematic shows. We anchor the portfolio most usually in hard assets. Then hedge the portfolio, and hedging can take several forms. For example, you may own stocks. Let's say you own all the stocks in the Dow Jones. Sell cover calls, collect premium on that. You mitigate your risk by doing that. So hedge the portfolio either by selling cover calls, buying puts. I remember in the week of November 9th, when we bought some puts, we made 103% in 5 business days. 103%. Because we bought, you may say it was lucky. No, it was not a lucky call. I looked at the futures were down and remained down the week of November 9th. We bought the puts and we protect not only capital, but we made on top of that 103%. So that's hedging. Then on the upper left corner, we talk about stream of income. We cannot leave any money on the table. So the example that I gave with the cover calls, if you own the Dow Jones or if you own S&P, sell some calls and eventually get a stream of income.
Since we are in an era of financial repression, you cannot expect the income from treasuries or from CDs. Exploit and explore all the sources of income. And then the upper right corner, execute the strategy with discipline and rules.
John, great advice. We have to wrap here. Any key messages you'd like to leave with our listeners that we haven't touched on? Because unfortunately, I've moved you around a lot of different.
Yeah, my feeling is that global trade, and there is a graph there that shows that global trade is slowing down significantly. We see the consequences for that, for example, in the shipping sector. You could have bought a vessel in 2012, 4 years ago, for $40 million, and you buy the same vessel today for $10 million. So if things turn around, that's a sector that potentially would have significant return. You buy the same asset at 75% discount. So there are opportunities out there. But will global trade eventually revitalize? That's one of my concerns. Unfunded liabilities are other concerns throughout the globe, not just in the United States. And then emerging currencies and emerging markets in general, from Azerbaijan to Nigeria, they will need bailouts, and we're going to see sovereign defaults. So mitigate your risk, hedge your portfolio, and anchor it well.
And how can investors learn more about the things that you're suggesting, writing, advising on, and recommending?
Oh,
how can they contact you?
They
or
can go into our
your
website, blacksummitfg.com, and they can take a completely free risk analysis of their portfolio. Eventually, they will have a tool in their hand, how much risk they can tolerate, how much money they're willing to eventually lose in a bear market. And if they want to contact us, they can email me. They can find my email, or they can call us, and we'll be happy to assist.
That's a great offer if they can do their own risk analysis enough to know or get a better feel for it, and then they contact you. And is that automated, John, or is that just a series of questions?
When you go to blacksummitfg.com, on the upper right corner, it has a box, a tab that says risk analysis. So you click on that, and you go through some questions, and the algorithm that we have there eventually produces a risk score. Then send us an email, or we're going to email you and tell you this is your score, and tell us what you want to do about it.
Yeah, you get an email saying you flunked. Maybe, I don't know, but it's better to know now than when the problem comes out and you're pulling your hair out saying, I flunked, because you've lost real money. John, great conversation. And there's so much in some of the slides we didn't have a chance to get to. I wish we had. We've got to have you back again. And we will later on this year. So, thank you for your time.
Have a good one. Thank you.
Thank you. Talk to you again. Bye-bye.